A sudden contraction in the U.S. labor market has wiped out expectations for a September Fed rate hike, reversing the momentum of global market structures. Today, we are breaking down the mechanics of this record equity rally, the supply shocks driving metals to historic highs, and three specific trade setups to capitalize on the shift. The negative payroll data has transitioned the market into a new regime, where economic contraction is currently driving asset appreciation. This trend shows the immediate impact of July's employment report. Non-farm payrolls contracted by 23,000, pulling 10-year Treasury yields down to 4.64%. Eliminating further rate hikes removed the ceiling on risk assets. As yields bottomed, the S&P 500 reached a record close of 7,758. Lower discount rates are driving capital into tech and AI infrastructure. Conversely, energy equities are stalling as crude oil drops 7% on the week. Removing the rate hike barrier completely re-rates growth stock valuations, establishing technology as the clear leading momentum play over defensive sectors. Precious metals are responding to this shift. Gold surged past $4,350 an ounce, supported by falling real yields and 14 days of gold ETF inflows from Chinese institutional buyers. Industrial metals face a simultaneous physical supply shock. The Democratic Republic of Congo has initiated an export ban on copper concentrate, impacting global refining volumes. This supply restriction is meeting surging demand from global AI power grids, which has pushed copper to a record $6.70 per pound. These price levels reflect deep structural deficits within the technology supply chain, moving beyond traditional hedging. In currency markets, we are seeing a sharp divergence. The US dollar is trending lower against both the Japanese yen and the Canadian dollar. The driver is the contrast in domestic labor health. While US payrolls contracted, Canada posted a blowout gain of 75,100 jobs in July. This divergence indicates that relative labor market resilience is currently a primary driver of currency performance against the greenback. We have identified three high-conviction trade setups based on these macro shifts. First, long gold. Buy dips toward $4,320, targeting $4,450, with a mandatory stop loss at $4,275. Second, short USD CAD. Sell rallies toward 1.3920, target 1.3780, and place a stop loss at 1.3985. Third, long copper futures. Buy dips toward $6.65, with a take profit at $7.10 and a stop loss at $6.48. Trading without a hard stop loss is a path to account liquidation. Protect your principal and maintain margin discipline as these macro trends develop.